Hello traders, and welcome back to our Babypips course for today. We have completed preschool course 1, kindergarten course 2, elementary course 3, middle school course 4, summer school course 5, and today we'll continue from high school, which is course 6, and we have from grade 9 to grade 14. Trading divergences, market environment, trading breakout and fake out, fundamental analysis, currency crosses, multiple time frame analysis. So we're going to start by talking about trading divergences. So here are the subtopics under trading divergences. Trading divergences is the first one, then regular and hidden divergences, the third one, then how to trade divergences. I'm just going to say DV. So when I say DV, you just know I'm talking about divergences. Okay, so how to avoid entering too early when trading DV, the 9 rules of trading DV and DV sheets. Then DVs are not a trade signal. So let's dive right into the first one, trading DV. And here it is. So what is divergences all about? What if there is a better way to know when to enter into the market, to sell near the top and to buy near the bottom of a trend? Would you be interested in knowing that? Now, if you believe a currency pair will continue to fall, but you would like to short at a better price or a less risky entry, so guess what? There's a way to find this out, and it's called trading divergences. In a nutshell, divergences can be seen by comparing price action and the movement of an indicator. So with this picture here, you see the first diagram to the top is the price action, right, on your chart, and the next diagram to the bottom is the indicator, right? And you can use whatever indicator you want to use. You can use the relative strength index, the RSI, the moving average convergence divergence, the MACD, the stochastic, and the CCI indicator. Okay, the great thing about trading divergences is that you can use them as a leading indicator, and after some practice it's not difficult to spot with your eyes. So the best thing about that DVs is that you usually buy near the bottom or selling near the top. Either way, right, it's a win-win for you. So trading divergences, now just think about it. Just think of higher highs and lower lows, right? Price and momentum normally move hand in hand, just like avocado and toast, Hansel and Gretel. Okay, that's how price and momentum they move. Okay, so if price is making higher highs, the oscillator should also be making higher highs. If the price is making lower lows, the oscillator you are using should also be making lower lows. However, if price is making higher highs, right, and the oscillator is not making higher high, then this is called divergence. Okay, they are diverging, they are separating from each other, they are not going the same way, because we just learned that price and momentum, they move in the same direction. So when one is moving in the opposite direction, it is called divergence, and this is a tool we are going to use to know how to spot quick entries, end of momentum, a new change in trend, and new change in market structure, and all that. Okay, so using divergence can be very useful in spotting a weakening trend or a reversal in momentum. Okay, so there are two types of divergences, the regular and hidden divergences. Okay, so let's move on and consider the regular divergence. Okay, so what is the regular divergence? A regular DV is used as a possible sign for a trend reversal. Okay, and there are two types of regular divergence, the bullish divergence and the bearish divergence. Okay, so the regular divergence goes this way, the regular bullish divergence rather. If price is making lower lows, right, but the oscillator is making higher lows, okay, this is normally what occurs in a downtrend. We call this a regular bullish divergence. We know lower lows, the market is going bearish, it's falling down, right? However, if the oscillator you're using, either the MACD or the RSI or the stochastic or the CCI, is making higher lows, it is diverging. Okay, and so this tells us that we are nearing the end of the trend and that the price of the market is about to reverse to the top side. That's how you use the bullish divergence. Take a look at the diagram you're seeing right now. The one to the top is the price, while the one at the bottom is the oscillator. As you can see, prices is falling down, making lower lows, lower high, lower lows, lower highs. However, the oscillator is making higher lows. Okay, it is diverging. Okay, so this way we know that price of the market is about to rise to the upside. Now, what about a regular bearish divergence? This occurs when price is making higher highs but the oscillator is making lower highs. Then you can call this a regular bearish divergence. Price is in an uptrend, however the oscillator is telling us or making lower highs. So after price makes that second high, if the oscillator makes a lower high, then you can probably expect price to reverse and drop. Now again, you see the diagram on your screen. This is price going up. Okay, so this is price making higher highs, right? However, the oscillator, right, is now making lower highs. This high is lower than this one, so this is why we call it a lower high. And this indicates to us that the uptrend is depleting and market structure is about to change and price is about to drop. So as you can see, you can use divergences to try to pick tops and bottoms. You are looking for an area where price will stop and reverse. The oscillator signal to us that momentum is starting to shift, and even though price has made a higher high or lower low, chances are that it won't be sustained. So now that you've got a hold on a regular divergence, it's time to move and learn about the second type of divergence, the hidden divergence. You don't need to worry about that. It's not hidden, it's not a secret. It's called hidden because this divergence is inside the current trend. Okay, so how are we to understand the hidden divergence? So earlier we covered the regular divergence, and now we're about to consider the hidden divergence. So divergences do not only signal potential trend reversal, but it can also be used as a possible sign for a trend continuation, and that's what brings us to these hidden divergences. Now we'll have the two types of hidden divergences: the hidden bullish divergence, a hidden bearish divergence, right? So when we are in a trend, the trend is our friend, that's what we always say. So when you're in a trend, when price is making a higher low but the oscillator is showing a lower low, right? No, we are in a hidden bullish divergence. So let's say a pair is in an uptrend, right? An uptrend will have higher highs, higher lows, higher highs, higher lows. Okay, so if there is a higher low, check the oscillator if it's making the same higher low. But if it doesn't and it makes a lower low, then we've gotten hidden divergence taking place. Okay, and what does that show to us? That is a possible trend continuation. Now the hidden bearish divergence. Okay, so this happens when price makes lower highs but the oscillator is making higher highs, right? If price is making lower low, lower highs, lower low, lower highs, however the oscillator is making higher highs, just know that the downtrend is going to continue falling downwards. So this is the hidden bearish divergence, the diverging. That's how you know the trend is going to continue in its same direction, which is the following. So if you're a trend follower, you should be able to dedicate some time to study divergences. Okay, regular divergences, hidden divergences. Keep in mind also that regular divergences are possible signals for trend reversals, while hidden divergences are signal for trend continuation. Okay, so regular divergences signal possible trend reversal, while hidden divergences signal possible trend continuation. That brings us to the next topic that says how to trade divergences. Okay, so how are we supposed to trade divergences? So first, look at the chart. Okay, let's look at the chart very well. Now this is the daily chart of the pair USD CHF, right? And as you can see, the price of the market of the chart is making lower highs and lower lows, right? So we have lower high, lower lows here, and a new lower low. However, the oscillator is making higher lows because this first low and the second low is higher than the previous first low, so it's making higher lows. Okay, so what do we see? We see that the prices, this is a very clear divergence, right? They're not moving in the same direction. The stochastic indicator should be making lower lows, but rather than making lower lows like the chart or the price, it is making higher lows. So this can signal to us that something is about to continue to happen, perhaps a change in this downward trend. Okay, so what should we do? According to what we have learned before, if price is making lower lows but the oscillator is making higher lows, right, this, especially on a downtrend, okay, this is a bearish divergence. Okay, and once it is bearish, what should we do? We should try to enter into the market and expect prices to bounce back up. So now we smell something is fishy, so what should we do? Right, it's time to buy. So if you bought, congratulations, boom, look what happened. Price rallied up to the top side. Okay, and yeah, you made a lot of bucks. Okay, and also, did you notice the tweezer bottoms here? The two tweezer bottoms, the very powerful candlestick formations. Okay, so what happened from the tweezer bottoms? Price rose, broke this high, came back for a retest here. Okay, price broke this level. Okay, this candle broke, came back for 1, 2, 3 retests here, and price shot back up. So if you had entered the market somewhere here, right, you would have ruled all these pips at the top side. Okay, and that's awesome. Great trade entry for you. So that's how you use divergence. So how do we trade the hidden divergence? Now we know the hidden divergence is to know, or hidden divergence is to know if a trend is going to continue in its momentum. If it's a downtrend, if we use it to know if it's going to continue to the downside. If it's an uptrend, we use the hidden divergence to know if the market is going to continue to the top side as well. So here we have a hidden divergence. What do we see? We see price making lower lows and lower highs. Again, this is also the daily time frame of the USD CHF, US dollar, and the Swiss franc. Okay, so we see the trend line, right? Price respecting the trend line, trading to the downside. Okay, however, when you look at the stochastics indicator, you see price making higher highs. Okay, it shouldn't be making higher highs because the chart, the price is making lower lows, so the stochastic also should be making lower lows, but in this case the stochastic is making higher highs. This is divergence. It is diverting from what the price of the market is actually doing. Okay, so what do? We can also smell something is fishy here. It's not right. Okay, the price of the market should be making lower lows. So if you had taken an entry, you can decide to take a short entry, or well, just sit back and relax and watch how price plays out. And if you sit back and relax and watch how price plays out, boom, what happens? You see the trend continued in the direction, and you'll be like, oh my goodness, if I had known, I should have shortened this trade. I should have taken a short entry. Now look at the stochastic again. Okay, after making the second high, this higher high, prices fell down, and yeah, you could have made lots of pips from taking this entry. Okay, don't worry about this image. This is Professor Savia. He pulled his hair because he failed to do what he ought to have done. So that is how we use the hidden divergences. Now let's take a look at how to avoid entering too early when trading divergences. How to avoid entering too early when trading divergences. So there are ways you can avoid this, right? So one way to do this is to be patient. Of course, if you're not patient, right, if you jump the gun, you find out that you experience so many stop outs, and so many stop outs will cause you also divergence between your profit and loss and your take profit. Okay, so you don't want that to happen. So one way to avoid entering too early is to wait for an indicator crossover. Just wait for a crossover of the momentum indicator. This would potentially tell you that the momentum is shifting from buyers to sellers or from sellers to buyers. Now, the main reason behind this is that you are waiting for the top or the bottom, and these can't be formed unless a crossover is made. Look at the chart we're seeing right now. The price is making lower lows. The indicator we are using, stochastic, is making higher highs, right? And this is clearly showing that we are in a downtrend continuation. Okay, so what do? The only thing to do is just wait for a perfect confirmation. Just wait for a perfect confirmation, and by the time you do this, you are going to ride the market down. Okay, patience is a virtue, my friends, and that is what we are learning here right now. So take a look at this other chart. Okay, the stochastic indicator shows us that the price is going to go down. The price action also shows that we are on the lower highs, right? And so look at the chart. The trade was, a winner, down trade, right? So playing the patient game can be very, very helpful. Another way to avoid entering too early into divergence trading is to wait for the indicator to move out of the overbought and oversold territory. Just wait for the momentum, higher highs and lower highs, to hit overbought and oversold conditions, and then wait for the indicator to move out of these conditions. The reason is that because we really do not know when the momentum shift will really begin. Now, this does not work for the price. This doesn't work. Don't connect your bottom, okay? Connect only tops. That's what we are learning. Rule number 4 is keep your eyes on the price. Okay, do not take a look at the indicator yet. Just look at the price. Once you have connected either to tops or either to bottom, look at your preferred technical indicator. Okay, and remember, you are comparing its tops or bottoms. Now, some indicators like the MACD or stochastic, they have multiple lines. Okay, so don't worry about that. Consider and focus on the tops and bottoms about everything else. Okay, now 5, be consistent with your swing highs and swing lows. If you draw a line connecting two highs on price, you must draw a line connecting the two highs on the indicator as well. Okay, do so for all of them. If you draw all line connecting two lows on price, you must also draw a line connecting two lows on the indicator. Okay, now this is a perfect one to go with. Okay, you connect this one, and here you're connecting this and this, here and here. Do the same, connect this and this, here and here on the indicator as well. Be consistent with it. Be consistent in drawing your lines correctly. Okay, correctly. Now keep price and indicator swings in vertical alignment. Price and indicator swings on vertical alignment. The highs or lows you identify on the indicator must be the ones that line up vertically with the price highs or lows. Don't just pick anything. Maintain a vertical alignment with the price swing highs and lows, with the indicator swing highs and swing lows. Here is what we're talking about. Maintain the same vertical alignments. Okay, like this. So once you've drawn, make sure you are able to take note of where you are. Okay, they must match each other. The price on the chart must match that on the indicator. It is very, very paramount that you do this. Okay, then watch the slopes. Divergences only exist if the slope of the line connecting the indicator tops or bottoms differs from the slope of the line connecting price tops and bottoms. It must be almost as beautiful as this. Very, very important to do this. So make sure you practice this, okay? Keep practicing and keep practicing. If the ship has sailed, catch the next one, okay? So if you spot a divergence but the price has already reversed and moved in one direction for some time, the divergence should be considered played out. You missed that boat, okay? All you can now do is wait for another swing high or swing low to start to form, and then start your divergence search all over again. Do not chase. Do not chase. Once it's gone, once you miss the trade, okay, try and catch another trade. 9. Take a step back. Divergence signals tend to be more accurate on the longer time frames. In that way, you get less false signals. Yeah, it can mean that you'll be having to take fewer trades, but if you structure your trade very well, then your profit potential can be very huge. Divergences on shorter time frames will occur more frequently but are very, very less reliable. So Babypips is saying take or look for divergences on 1 hour charts or longer, and they're saying some people used to look at the 15-minute charts or faster ones, but they don't, because it has lots and lots of noise, okay? So follow these 9 rules. If you follow these 9 rules, which is a must, right, you'll be very, very skilled at trading divergences or using it, okay? However, if you fail to take these rules and follow these principles, your account is going to take a hit, and then you're going to have lots of divergence between your account balance, your equity, and your take profit, okay? So here we are on divergence sheet, okay? So what have we remembered so far? What have we learned? Let's recap. There are 2 types of divergences, okay? First one is a regular DV, and the second one is a hidden DV, right? And each type of DVs will contain either the bullish bias or the bearish bias, okay? Now, since you have all been studying hard and not been causing classes, decided to help you out, causing it like that, by giving you a divergence trading sheet. Okay, baby, which is funny. Okay, so the regular divergence, here is a bias. If it's a bullish divergence, the price action will be making lower low in a downtrend, okay? However, the oscillator will be making higher low, and that tells us that the momentum or the structure of the market is about to move from downtrend to an uptrend. Now, if it is a regular bearish divergence, the price of the market will be making higher highs. However, the oscillator will be making lower highs, and that tells us that the strength of the bulls is weakening. Structure, price, momentum of the market is about to shift from uptrend to a downtrend. And then we'll have the hidden divergence, and we'll know what is useful to know the trend continuation or not. Now, the bias is this, and if it's for the bullish hidden divergence, that tells us that the trend is going to continue higher. And what are we seeing? What should we be looking at? The price of the market should be making higher low. However, the oscillator is going to continue to make lower low. This is a good entry because it shows that there is a retracement in an uptrend, and it's nice to see that the price retest of previous lows, and we are to buy the dips. However, if it's for a bearish hidden divergence, okay, the price of the market should be making lower high. However, the oscillator should be making higher highs, and this indicator shows that it's time for us to rally behind the sell. So why DVs can occur between price and any other piece of data? They are most commonly used with technical indicators, especially momentum indicators like the oscillators, including commodity channel index, the CCI, relative strength index, RSI, stochastic, and the Williams percentage range. So you can try and remember all of this, but if you don't remember them, write them on your palm if you want to, and then you can go back and look at your palm to remember them. Anyway, I'm just being silly, but that's what they said. So try and bookmark this page if you want to, or write it out, all these tips on sheet of paper and keep it beside you, place it on your walls, okay, and do not mix them up. So let's go and consider the next lesson. Divergences are not a trade signal. Okay, so we don't use divergences, DVs, as trade signals, rather as an indicator to try to show what is about to happen. That doesn't mean it is going to happen, because you cannot predict the market. Okay, market is action based. You do not predict. Okay, it's reactive, not predictive. So you act and take action based on the reaction you are seeing in the market. Okay, so you just cannot base all your trading, right, solely on divergences. Okay, you use DVs as setup condition combined with additional confirmation tools. Okay, and that way you have a high probability of winning your trades with relatively low risk. Okay, however, there's a way to be more advantageous in trading divergences, and one way is to look at trend lines or candlestick formation to confirm whether a reversal or continuation is in order. And then another way is to make use of momentum tricks by watching out for an actual crossover or waiting for the oscillator to move out of the overbought or oversold region. So we'll look at the chart before us right now. We see the trend line on price, okay, and then we see the oscillator. They are definitely diverging, okay, but what do we see? If you had bought base of the oscillator because it's in an oversold region or area, if you had bought, and what would have happened? You would have lost the trade because price of the pair continued to head lower and lower and lower. Okay, so you just can't base your trading or your entries based off on your oscillator or divergences alone. No. Another way you can become more smart is to draw trend lines on your oscillator and also on your price chart. And look at the chart we have before us right now. We have the trend line on the oscillator. We also have it on the chart. So what do? After drawing it, we'll just wait for the price to break the trend line, okay, or the break wall. Wait for price to break it, and then look for an entry and enter into the market. So if you do this, it will not be difficult for you to make good trades, and also it will not be difficult for you to spot false signals and filter those out, and you always position yourself at the right side of making profit. It's not easy anyway. You have to train yourself to be able to spot good DVs. So remember, taking no position is a trading decision in itself. Okay, it's better not to trade or hold your position, right, like not getting to the trade, than to risk it on ideas that you cannot confirm yet. So remember this: DVs don't appear often, but when they do, it is left for you to pay more than the usual attention. Remember, regular DVs can help you collect a big chunk of money because you are able to get in right when the trend changes. And also, hidden DVs can help you ride a trade longer, resulting in bigger than expected profit by keeping you on the correct side of the trend. Okay, so it is important for you to remember this. Now the trick is for you to train your eye to spot DVs when they appear and choose the proper divergences to trade. Okay, cherry pick your setups and you will increase your odds of winning your trades. So that brings us to the end of DVs, divergences. Next, we'll be considering market environment. So you have concluded grade 9, of course 6. Bravo. Please remember to turn on your notifications so that way when we release our new courses you'll be notified. And also, if you enjoyed this video and you've liked it and if you've not subscribed already, please smash the like button, subscribe if you haven't, and until next time, take care.